Let's talk about portfolio management. In today's session, I would like to follow up from where we stopped in the previous session. Today's theme is going to be something called portfolio management. It's a buzzword that is quite popular within um, the investment industry. It's also very popular within academic institutions that teach valuation, corporate finance, and accounting or investment theory. But before I go into portfolio management, let me take a step back and bring in um, a four-letter word that is critical to portfolio management. That word is risk. Two sessions ago, we talked about um, risk aversion. And one of the questions that I addressed was I said it's important for you as the investor to understand the degree of risk aversion that is acceptable to you. We all have different levels of risk aversion. Everyone has a degree of risk aversion. The question simply is how much or how little. In order for you to proceed with portfolio management, you must go a step back. One reason for that decision is you cannot manage a portfolio until you've decided what should be in that portfolio. Now, I'll say that again. In order for you to manage a portfolio, in other words, in order for you to practice or execute on your strategy of portfolio management, there has to be something in the portfolio. And that simply means that portfolio construction precedes portfolio management. However, asset selection also precedes portfolio construction. Which brings me very, very timely to where we stopped in the previous session. In the previous session, we talked about the strategy you might choose, active or passive. I explained that the active approach to investing is one that should be engaged upon by specific groups of people. And there were characteristics or qualities that I said were necessary in order for you to consider yourself ready to be an active manager or in order for you to invest actively. Now, I should qualify something and say that I'm referring to right now equities. And by equities, I'm talking about fractional ownerships of publicly listed buildings. But it should also include private businesses, should you find that of interest. I am not referring to real estate right now. We'll talk about all asset classes when we get to portfolio construction and portfolio management. We'll also deal with that when we come to asset selection. Choosing between active and a passive approach comes down to the investor. I said you need the skill set. By skill set, I made it very clear that one of the things you needed was an understanding, but also a very sound appreciation and knowledge of valuation, security analysis, finance, accounting. And I explained that all of these fields of expertise were like ingredients that provided the best meal or recipe as a good investor. Accounting is the language of business. Corporate finance is the ability to look at a business from the inside out. Evaluation is simply looking at a business from the outside in. Security analysis is the ability to analyze companies. In other words, In order for you to look at business from the outside in or from the inside out, you must understand how to analyze companies or securities. By securities, I'm referring to fractional ownerships of, specifically in this case, equity securities, meaning publicly listed companies. You could also look at debt securities, which is simply dealing with securities such as bonds, for example. So if you choose to be an active investor, then you need to understand how to select the right assets, construct the right portfolio, and then manage the portfolio. On the other hand, if you choose to go down the path of passive management, then all you have to do is choose. In other words, the passive approach. And a passive strategy might simply include buying indices. So it's simply a case of choosing the index or the indices that will be in a portfolio. So there's very, very little work on your part. I'm going to go through the passive approach rather quickly because there isn't much to say about it. If you choose a passive approach, you're simply saying, I do not have the ability. Now, forgive me, let me go one step backwards. I was explaining the qualities and the characteristics that you need to have to be an active investor. The skill set, then the mindset, and that deals with psychology. But more importantly, the mindset also requires a lot of financial history, understanding financial markets, your ability to read and understand market cycles, economic cycles, your ability to recognize and understand macro factors, inflation, interest rates, growth of economies, currencies. In many ways, it even requires an understanding of geopolitics, understanding what governments could do and the relationships between governments. Number 3 is you need time, because to do all of that work, you can't do it on a part-time basis. It's something that requires the allocation of time. And I said, if you do not have all those 3 qualities, or if you're unable to meet those 3 requirements, then possibly the passive approach should be the right one for you. Who knows, maybe you might even want to consider a hybrid. Now, for passive investors, you simply have to choose if you're buying stocks or equity securities. Both are the same. I use both interchangeably. Now, you must forgive me for mixing it up, but they're both the same. Publicly listed companies, stocks, shares, and equity securities. Whenever you hear me use any of those words, then recognize that I'm referring to simply buying fractional ownership or ownerships of businesses. When you've decided to be a passive investor, to construct your portfolio, because in this case you're not selecting companies, so there is very little asset selection in this case. Now I'm narrowing my explanation to stocks only. You can have a portfolio still following the passive approach that includes stocks, that includes bonds, that includes real assets such as gold. You can even have digital assets. So for example, as a passive approach or passive investor, to construct your portfolio, the first thing you need to do is choose what index would you want to have in your portfolio. The passive approach follows the principle that says, I am unable to select assets myself. I do not have the 3 requirements, or I do not meet the 3 requirements, and I do not have the qualities needed to be an active investor. Therefore, I am going to allocate a certain amount of capital across a certain group of companies. Those companies are chosen by what we call a benchmark, an index. In the US, it could be what's called the S&P 500. It's the 500 a list of the 500 top US publicly listed company in a particular index. In the UK, we have something called the FTSE index, but there are multiple versions. There's the FTSE All Shares, which simply means you invest in all of the UK publicly listed companies. There's the FTSE 100, the first or the top 100 companies in the UK. There is the FTSE 250, which is the 250 companies underneath the first 100. We have the FTSE 350. So you choose, firstly, what index. Are you going for US companies? Are you going for UK companies? Are you going for emerging market companies? Or are you going for European companies? You choose the index. Now, secondly, you might decide, I like gold. So then you have to choose what index, what gold index you want. If you want bonds, then you have to also choose the bond index you want. And once you've made that choice, that's your portfolio. The management process is not done by you. You simply buy and you simply review. Very simple. You buy and then you review. It's a case of just checking on your portfolio to see how you are doing over time. That ends the passive approach. Let's move to the active approach, because the active approach requires a lot more effort, time, commitment, and work. In order for you to manage a portfolio, I said that there is something you must do first. I said you have to choose the assets that will be in that portfolio. That's the first thing. You have to choose the asset. Effectively, you go through 3 steps. In order for you to manage the portfolio, you have to construct it. In order for you to construct it, you have to choose. In order for you to choose, you must have clarity on your objectives. So the first part is understanding what are your objectives. That's the first. Once you have your objectives identified, then you can start the strategy, which is the building process. I'm going to give you very quick snippets. Unfortunately, in this session, I will not go into the detail. My whole idea from these sessions is to show you or teach you how to think, not to show you what to do. Because if you can think right, then you will act right. But if I tell you what to do and you lack the most important, which is how to think, when things change, you find that you're stuck. Or to put it in a different way, you find that you're always dependent on me or the teacher. There is a saying, if someone is hungry, you teach them how to fish. If you feed them, then you have to feed them for a lifetime. If you teach them how to fish, then they can feed themselves and even their loved ones for a lifetime. Number 1, the objectives. I cannot contribute to your objectives. But the question is, what do you want? Now, if you've paid attention to the sessions that I did previously, the last 5, 6 sessions, you should have an understanding of how to write, capture, or express your objectives. It's very simple. Objectives is simply another word in this context that I might substitute or I might use to describe your goals. What is your vision? What do you want? What are your objectives? Now, you might decide, based on your level of risk aversion, that capital preservation is very important to you. Therefore, in selecting your assets, you would choose assets whereby the risk is very low and uncertainty is very low. However, the returns you will get will have to be quite low as a basis. So number 1, choose your objectives. And let's move very quickly to your strategy. I will use an example, or I will use examples to perhaps guide you. Now, none of these examples should be used in a portfolio. Because in order for you to construct your portfolio, you must understand yourself. You must have an objective. So I'm going to use an example just to illustrate the process of going from asset selection to portfolio construction to portfolio management. Let's say, for example, you have an interest in stocks. First question, do I want to be what I call a market? Do I want to select my asset based on a market, a sector, or individual companies? Let me explain what that means. When you choose a market, you will simply say, I do not want to focus on the micro. I want to go up a little bit higher and look at the entire market. So you might say, like passive investors, you might say, I will choose various indexes or indices. The indices I choose may not be all passive. They could be actively managed indexes. But you're choosing a market. When you choose a sector, you've come a step further down and you're saying, I do not want to look from the top. I like to come down a little bit more, because in a market, you have several sectors. So you might decide, I like the retail industry or sector. You might say, I like the airline industry or sector. You might say, I like the oil sector or industry. That is sector allocation. You might go a step further and say, I like to play this game at the lowest level. Now, by using the word lowest level, I'm not referring to performance. I'm simply referring to hierarchy, not hierarchy based on performance or returns, simply hierarchy based on what you might call a structure. So at the top, you have the market. Within the market, you have sectors. Within sectors, you have companies. You might choose to be the type of investor that selects companies one after the other. That's the first thing you have to do. Now let's use the example and say you've decided to select the companies yourself. Number one, it means you can choose companies from several sectors. You might choose a technology company, say Apple. Then you might decide, I like to choose an airline company like Boeing. Then you might decide, I like to choose a retail company like Nike. What you've done here, follow this very carefully, without realizing you are choosing assets, but also you're constructing a portfolio. Now I'm going to introduce, or I will introduce, a word. The word is diversification. It's the first time I've used that word in this entire session. I've left that word out for a specific reason. Diversification is a word that is used by active managers, people who work within the asset management industry or people who work within investment management industry. It's a word also used within universities, MBAs, if you're doing accounting or corporate finance, or if you're doing investment management, or if you're doing security analysis as a course. Diversification simply means that you do not know as much as the future as possible, and therefore you're trying to spread your bets. Mama used to say, never put all of your eggs in one basket. By putting your eggs in several baskets, you're diversifying. You are simply saying, I cannot take all the risk. Unfortunately, I'm going to say something that I don't want you to take the wrong way. Warren Buffett, or should I say Charlie Munger, Warren Buffett's long-term partner, said that diversification is for know-nothing investors. That's Charlie's word. Warren, on the other hand, says that diversification is a protection against ignorance. In other words, you diversify when you do not know very much. Professional money managers diversify because they can't afford to put all of their investment in very focused, special niche portfolios or assets. Why? Because simply the structure of the organization prevents, or in some cases, the funds that they've been able to generate from clients specifically request that they diversify. So you might have some investors who have 100 stocks in a portfolio. Now, I have a problem with diversification. Think about this. If you diversify your assets, within that portfolio, there are some assets that you know a lot about, and there are some assets that you do not know as much about. And what you're simply doing is distributing your capital from the one you really know and you're certain to the one you least know and are uncertain. Now, the whole idea is when you mix everything up, for some reason, it gives you an average. Should something go wrong with one, you're protected. That is evidence of a lack of deep knowledge or certainty about your selection process. I'm not saying it's wrong. I'm simply saying that the investors who do very well are usually more focused. It means they've studied the investment, they've studied the company, they understand the sector, they're able to look out 10 or more years and understand what could be. Sam Walton once said that before I invest in a company, I study the company and I ask myself, where will it be in 10 years? And if I cannot identify very, very clearly where it will be in 10 years, and if I cannot do that within what I call an educated, creative, reasonable, and confident way, I do not invest in the company. What he's saying here is, if I can't see 10 years ahead, I'm not interested. So if you are very good, you might still have companies in your portfolio, but you might have a handful of companies, 10, 12, 15, but not 200 companies. Because the whole point is you can't like number 1 as much as you like number 200. And you cannot know a lot about number 1 in the same manner as you know about number 175. The point being, as you move your investment to assets that you do not know much about, now you're speculating. So the whole idea is diversification is important. You should choose whether you diversify or not. You should feel confident within yourself to choose not to diversify or to choose to diversify. There's nothing wrong with choosing one or the other. Remember, it's your investment. You get to make the choice. So we go back. You selected a few companies. By choosing Apple, by choosing Nike, and by choosing Boeing, you've gone for retail, you've gone for technology, and you've found yourself in a different industry called airlines. It means on a sector basis, you've diversified. The next word I'm going to talk about very briefly is correlation. Correlation. How are the assets correlated? Would something negative within the airline industry affect the retail industry? Would something within the retail industry affect the technology industry? So when you're selecting assets, you're looking at, are they correlated? And if you choose the approach whereby you're trying to diversify because you care so much about performance and you're not quite sure about the future, then you ideally would like to choose assets that are not very much correlated. Gold is a useful example that people tend to have because they say gold is not very correlated with the different assets. Real estate is also another asset that people say is not too correlated with other assets. They've all changed in the last 35, 40 years simply because of securitization, in other words, securities. Nowadays you can have what's called a real estate investment trust. It's a security now, meaning you securitized the real estate. The same for gold, the same for other assets, meaning you've created derivatives of an asset. So you can buy fractional ownerships. And for that reason, you find actually the real estate market and the stock market and the bond market and even gold are correlated. There's only one industry that is not directly correlated with the other four I just mentioned, and that is digital assets. In other words, cryptocurrencies. They are the only asset class that is not yet correlated with all the other asset classes. Now that might change in the future, but as of 2020, they are not. So you've chosen your assets, you've diversified. The next thing is you take all of those assets and you put those assets in a portfolio. You've now constructed a portfolio. So you've gone for objectives, tick. Assets selected, tick. Construction of a portfolio, tick. Next, portfolio management. To manage a portfolio, you can do in two ways: strategic and tactical. I'm not going to go into the details. I'll simply say this: portfolio management simply means reviewing your assets, recognizing the returns, recognizing the risk you're taking, then calibrating your portfolio or making changes to your portfolio as time goes on. Let me give you a good example of why the passive approach is a little bit more attractive to a lot of people. When you select an index like the S&P 500, you've chosen 500 companies, the top 500 companies. However, not every company on that list gets equal allocation. It varies from the top downwards, but also not every company on that list stays on that list. Sometimes you might have an asset, or a company rather, that falls out of the top 500 and another company goes in. What that simply means is if you follow the passive approach, then you simply you don't have to do anything, because the passive manager or the company responsible for managing your passive portfolio does all the work for you. It's really that simple. However, if you're an active manager, because you have assets in your portfolio, you're reviewing and analyzing the companies as time goes on. You might find that the operating margin of one of the companies is starting to go down. You might find that it's not returning as much of a return as it normally would. And therefore, you decide that looking ahead, the performance will be poor. And you might want to remove that asset from your portfolio. That is simply portfolio management. It simply means you manage what's in your portfolio. That simple. I hope this has been useful. So let me summarize. In order for you to be a portfolio manager, there are a few steps you must follow. The first is you must have an objective. Next, you must follow a strategy. The strategy will consist of firstly choosing the approach you want to follow, choosing the assets. You might decide, I'm going to go for market approach or sector approach or individual company approach. Asset selection, that's the first step. Number two, constructing a portfolio. And that portfolio could be simply stocks. It could be some stocks, some bonds, some real estate, some gold. That's your portfolio. Once you've constructed a portfolio, then the question is, it has to be managed. The most important part of investment, if you do it actively, is the last part, portfolio management. That's what you're paid to do, but also that's what you gain when you do it well. You might choose the right assets, But if you don't manage your assets well, you're in trouble. If you're a passive investor, then you don't have to worry. All you focus on is simply choosing what goes into your portfolio. And then you take a step back. Now, that's where we'll end today's session. I hope you found something interesting from today's session. Remember, you can choose to be a passive investor. You can also choose to be an active investor. The decision you make should not be based on people's opinions, including mine. It should be based on an understanding of yourself and an understanding of your limitations, your abilities, and most importantly, your vision. Historically, people who choose the active approach do worse than people who choose the passive approach. So, in many ways, you can still achieve a high level of return, still engage in whatever vocation you have, especially if that vocation is not investment. You can even spend more time on your leisure activities and still do well. So there's so many advantages of being passive. If you choose active, then I guess, like me, you're always in for a bumpy ride. And it's fun, it's exciting, but it can be very, very painful also. Choose wisely.